All right, so this is the first part of Chapter 10. Chapter 10 is all about cost recovery. And so there's a lot of depreciation stuff in here. And this will be particularly useful for you guys working on your tax return projects, because you're going to have to depreciate the boat and the condo for the periods of time that the condo is rented. And the boat is, of course, a business asset for Rich, so that gets depreciated as well. So here we go. So what is Chapter 10 all about? Chapter 10 is all about different forms of cost recovery. Okay, so we know that businesses must capitalize the cost of assets with a useful life of more than a year. All right, and if we think about Chapter 9 and that 12-month rule, then this makes sense, right? Because we have to capitalize things that have a useful life, that give us a benefit for more than a year. Okay, so you can't expense them immediately. Now, we're going to find that there are some situations in which you can do a lot of immediate expensing, and the Tax Cuts and Jobs Act has certainly changed this world a lot, but this portion of Chapter 10 is a good intro to kind of the theory around cost recovery and how to calculate basis. Okay, there are multiple parts video-wise for Chapter 10, so pay attention to those. All right. Okay, so we have different methods to recover the costs of different assets. Okay, so depreciation is used for, oops, got to change my pen. Tangible personal and real property. Okay, but it should be noted, not land. Land does not get depreciated. All right. Amortization refers to deducting the cost of intangible property. So, okay. And then depletion is used for natural resources. Okay, so all three of these things, depreciation, amortization, and depletion, are methods of cost recovery, but they relate to different types of assets. And so it's important to keep those different types of assets straight. All right, so the other thing we need to talk about, kind of as an intro to cost recovery, is basis. And we've talked about basis quite a bit, but now we need to think about original basis versus adjusted basis. So original basis involves all of the costs required to place an asset in service. So what are some common examples of this? Purchase price, sales taxes, costs related to redesign so that it can be used for a particular purpose. All right, these are all potential items for the original basis. Now, adjusted basis, all right, is your initial basis minus accumulated depreciation. All right, now, when we're talking about cost recovery, you've got all different types of assets that we've already covered, and then which cost recovery method associates with that type of asset. And so here they're all laid out. So you can see personal property and real property, depreciation, intangible assets, all right, and a couple of examples, amortization, and then depletion. All right, so next, we've got this basis example. So let's take a look at this basis example. And unfortunately, the last line is hard to read, but I'll help with that. So what we've got is, we've got this company. They're a scrapbooking retail chain, and they purchased an old office building for $175,000, and they're using it in operations. An additional $15,000 was spent painting and remodeling in preparation for its opening. 2 years later, an employee discovered that several leaks in the roof were causing serious water damage to the store's inventory. They spent $50,000 to re-roof the building. Every 6 months, they pay $500 to have the carpets cleaned. Okay? So, 2 questions. First of is, what is the initial basis of the building? All right? So, let's answer that first question. So, what's the initial basis? Well, what do we know? We know we had purchase price of $175,000. What else do we know? We know an additional $15,000 was spent painting and remodeling in preparation for its opening. So what does that mean? Those are costs to get that building placed in service. So those $15,000 of redesign costs, if you will, are absolutely part of its initial basis. Okay? Everything else happened after it was placed in service. So its initial basis is equal to the sum of those two things. And so that's $190,000. Okay? Now the next question, which is obscured a little bit on this slide, is what effect do the other 2 transactions have on the initial basis? Okay? Other transactions. So let's talk about them. All right? So the first one, let's talk about every 6 months. Well, what is cleaning every 6 months of $500? Okay. This does not impact basis at all. These are routine maintenance costs, so therefore they're expensed each year. So we could call them cleaning costs. Okay? Now, what about this $50,000 spent to re-roof the building? Okay, let's talk about that one. All right, so we've got re-roofing the building of $50,000. Well, what does re-roofing the building do? Re-roofing the building potentially extends the useful life of the building. So what is that going to do? This is going to add to the adjusted basis when the re-roofing takes place. Okay? So re-roofing that building is actually going to change the basis then from that period forward. So that will be an additional $50,000 added to the basis. Okay. All right, so what is the system used to calculate depreciation for tax purposes? It's the Modified Accelerated Cost Recovery System, otherwise known as MACRS. Prior to 1986, we had ACRS, but MACRS is the only tax-approved way to depreciate. Okay, so what does that mean? For financial accounting purposes, so for financial accounting, you can use other methods, but you have to use MACRS for tax. And so this results in book-to-tax differences, okay? And so you've talked about those probably in financial accounting. All right? So we're using MACRS for tax purposes. What do we need to know in order to calculate MACRS? Well, we need to know the asset's initial basis. All right? We need to know the applicable depreciation method. We need to know its recovery period or depreciable life. And then we need to know the applicable depreciation convention. Okay? Now, what's important to know is that all of these items are determined by the Internal Revenue Code and Treasury Department guidance for the most part, okay? You do not have a lot of flexibility with tax depreciation. For the most part, tax depreciation is decided statutorily for you, okay? That is all of the intro and the basis portion of chapter 10.